Please tell me. Tell me what we analyze in an income statement.
It's what helps you know like it's the company's revenues and expenses during like a particular period.
But that per se, yeah, those are the elements, but that per se tells you something. The amount of income they received tells you something. What thing would you analyze exactly? Tell me.
I mean, based on revenue and expenses, just like how the company is performing, you know, if it's actually making profit or if it's losing.
Yes, that's the basic idea of the income statement. But for example, just an income line, how you would make an analysis from it?
I don't really know. Like, I'm not sure.
Because at the end, per se, an income line wouldn't tell you that much. At least what you can see in the note, it would be how much units did you sold, how did the revenue increase compared to previous years. Those are two analyses, and there is a third analysis that you can do comparing the amount of revenue in your industry. So you would have, if you add up all the revenues from that industry, you probably would get your market share, right? So but it's very difficult to analyze just a line per se. What most of financial managers do is to analyze ratios or margins. Forget if that's a projected income statement. Imagine that this is 2020. Don't worry. So as you see from Daimler's example, the first line that I have is incomes, then costs, and then the net revenue. The net revenue, don't mix up with the names. There's even in the book, there's even, have you read the book, guys? I hope so, but there's even an example in the book where it says that the accountants always change the names, and it's a matter thing of a rule, but don't worry, and maybe kind of the culture, but the important thing is that you get the concept. So the net revenue, it's also commonly known as gross margin, which is as easy as income minus the cost. Okay, so income minus the cost will give you the net revenue, and you divide the net revenue against the gross booking or the income, you will get this ratio, which is kind of the most important thing to start in analyzing, because in here, these margins would give you how, please give me a conclusion. Give me your conclusion of this easy division. What do you guess? And this is what you will receive from your accountant, and this is when you will start analyzing your financial statements. Okay, remember, first thing, I would request the statement, and then I would have to ask in which language to read it, probably in IFRS. But now that you have those things, the first thing that you want to know is how is the performance of the company? And this is one of the first things that you will have to do. So what can we conclude from this analysis? Please tell me. Who can tell me? What can we know with the gross booking, with the gross margin or the net revenue?
I would say that your costs are too
high. Those are one of the conclusions that you can get, but at the end of the analysis, because you don't have criteria in order to know what is a good gross margin. Because if you have 5 years, like you're watching in the Excel, at the end, they average like 10%. So probably the first year was not that good because I had greater cost in there, but the next ones do. So that's the important thing that we have to know. But what is the cost, or commonly know COGS, cost of goods sold?
You mean what actually it's a cost?
See, yeah. What's the cost? How can we know?
Like the money you need to operate.
That's what everybody thinks. Careful. It's just what you use in order to sell. But remember the examples that we did, like the mug. The mug cost me 100 and I sold it for 200. Only the mug, but the things that incorporate that you need in order to sell that mug. If you invested in some marketing, in a sales representative, in electricity, from an you have to do some math that we will see actually in managerial accounting in order to get how the electricity that you use will be incorporated into the cost of your goods to be sold. But that's the things that we're going to start analyzing. So now that we know that we can analyze the gross margin, what does it tell you the next line? I'm telling you the elements, right now the official elements of the income statement, because we haven't talked to yet which are the correct ones. You know what it's an income, what it's a cost, and what it's an expense. But there are some few elements that we need to properly analyze, because these are the elements that everybody as an investor analyzes. Which are the first one is how much gross profit your company receives. The second one is how much operating income you are generating. Who can tell me what's an operating income? And this is one of the most important.
The amount of profit realized from a business.
Can you repeat, Edwin?
The amount of profit realized from a business.
After deducting the expenses.
Okay, but why it's called operating income?
Is the money that you receive just for your operations.
Okay. It's not a bad definition.
It's the money that will eventually become profit.
Everything are good elements. Okay, but the great part in here, it's why is so important the operating income, and that you learn this definition. These are rule of thumbs, guys. Believe me that these are the first things that you will see in order to analyze financial performance. The operating income, if you remove from the operating income calculation what is the depreciation and amortization, it would give you almost what you have as result for the cash flow. That it's why it's very important, and it's commonly called EBIT. So if you guys, there's even a page is defining earnings table in the book where it tells you what is EBIT. It's a very common name, and actually it's part of your business economics. They will, if you're raising capital or financing, they will request this information, the EBIT, which means earnings before interest and taxes. Did you guys knew that?
No, not really, but it's spelled basically like debit, but without a D, because it's a B, not a V, right? That's how you write it down?
Yes.
Okay.
Yes, exactly.
Just wanted to know how to spell it.
Just don't get it confused. Eh? It's nothing related to debit or credit. But the EBIT, it's the first economics or the first and you don't need to know the final result, guys. You analyze at the end as an amount. That's the first thing, but the important thing is what you analyze as a margin, because at the end it will give you how much you are earning after your expenses. And obviously the ratio will give you what conclusions we can get from this ratio. You, Marcelo?
I saw your cursor was to the right of the screen, and I don't know why the Excel that you have doesn't fit my screen. I didn't know what you were showing.
What conclusions do you think that you can get from the margin of EBIT? What's the operation? First of all, what you do is the operating income, the total amount divided against the income. That's the first thing.
Well, how expensive your operations are compared to each product or service individually. So like, oh, it's costing me too much to to produce it or be able to sell it.
You got it right partially, but remember that we are not in managerial accounting. This is a whole level. You can't analyze by product or business line just from an income statement, consolidated income statement. What we use it for is in order to analyze, if you have your industry statements, now you can analyze the EBIT margin compared to the industry margins, because if you got a 5% and in the industry, everybody's getting 10%, what's happening in yours? Are you doing the things wrong? Or maybe you have a different strategy in order to achieve more sales. Those are the things that we have to analyze. At the end, you have your interest, taxes, and other incomes and other
So
expenses.
teacher, I'm sorry. So operating income is just the money you get before the taxes, right?
Yes. Interest and
That's it.
taxes.
Okay.
It is important because at the end, if the financials cost or the financing cost of your company is high, you would have it in another line. And that's why it's important, the structure. And,
Okay.
and right now, it's not even called just consolidated income statements. Actually, there is a new part that since 2013, if I remember properly, they IFRS demanded a new part called a statement of comprehensive income. As you're watching here, there's a net profit in the income statement. Everybody knows that, no? At the end, if you add up income, cost, expenses, you get taxes, you get to your net income. Perfect. Until here, we're okay. Don't worry about this part. This is more, I will tell you this a little bit more complicated, but you have in here other comprehensive income, and this is part of the statement. It's called income statement and other comprehensive income statement. And why we have incorporated this thing, as I told you, with the interest and other income means income that you receive from your business that it's not related to the primarily purpose of your company.
Okay.
If you're a travel agency and, for example, I sold a fixed asset and I got some earnings from it. I'm not dedicated to sell assets. I'm dedicated to the travel agency, but in a matter to, so it won't affect the margins of my normal operation. You open a business line before the operating income in order so you don't affect all the margins and you can put it in there. That's the purpose of other income, other costs, and interest earnings or interest costs from financing, these ones. And why do you have interest income? That's an important thing, because you will have it. At least if your accountant doesn't know, you can know and you can start generating income from interest. But how we would do to earn some interest income? Because at the end, who can tell me what's interest expense? If you get a credit, you will have an expenditure, no?
There is a rate you gotta pay for the bank for the loan. That's all.
Easy. And how we generated income from interests? Dalila, can you tell me?
What was the question, teacher?
How we can generate interest income? How do you think?
Perhaps you on how much
Borrowing
it
money.
Yeah. But that was a very difficult way to generate interest income. You can do so, but the thing is, when you properly manage your cash flow, you will have what you have earned today and what you have to pay in the future, right? That's a properly managed cash flow. So at the end, what if we manage to tell all our suppliers, and it's a very common thing, that we pay only on Fridays. So all the operating income that I generate from Monday to Thursday, I have it in my pocket. And what can I do with that? Can I invest it from Monday until Thursday so I can pay on Friday? Wouldn't be a great thing to earn from my operating income, and it's not my income. It's not, maybe I owe that, but I can arrange to, and it's a very common practical thing. You arrange to say to tell all the suppliers that you pay on whatever day that you guys do you want, and the rest of the days you generate an income cash flow, and you can see if you have a positive balance, you can invest that balance in what we called night operation. You can call your bank and tell him, I want to invest until Friday or maybe until tomorrow this amount, and I can start to generate income from interests. It's a very nice thing, guys. A lot of companies don't do that, and it's very easy. It's a matter of even in the, I don't know, in BBVA, there's you can do it in the portal. So now you know it's what's interest income, interest expense, why we use other income and other expense lines after operating income, and then you will get your taxes, or that business line, that line, it's very obvious, and the net profit. So what is the net profit? Anybody?
The money you got at the end after paying everything, every expense, every cost, taxes, everything. Money you get left.
That's it. Perfect. And why we open this other comprehensive income thing? That it just make it more difficult for us.
Exactly, no sense of opening that. More difficult.
It's kind of another thing, like I told you from the other income, other costs. This line, it's dedicated only for things that are not that business related and could potentially affect your margins. Let's give you an example, so you won't get afraid. What if you solve a business line? So you have 20 companies and you solve one business line. Imagine if you incorporate all the income that you will generate in that business line, from selling that business line, into your margins, into your operating margins. What would happen? And it's kind of the same thing that why we don't register assets, fixed assets in the income statement. What would happen if you incorporate that you sold a business line into your operating income? The margins would go up, no? All margins would be very affected, both super affected, because imagine that you sold it from millions and millions of dollars, and that's something very probable if you want to. But it's it's a little bit of understanding more concepts, but at the end, for us to, in order to analyze properly, it's better, because at the end, what I told you, the purpose of actuarial accounting is to stabilize figures, so we can then project. As you might see, okay, in the gross booking or the net revenue, it's very stable, 10%. And the net profit in here, as you can see, if we remove only 1 year, the first year of 2021, you have very stable figures. So now you can do projections. And imagine if you incorporate this kind of not very common transactions that maybe only happen once in 5 years. That's the purpose of the comprehensive income, guys.